Hello and welcome to this week's episode for Spy Trader Now. I am your host. My name is Ken and our model portfolio is up 0.19% year to date. We currently have a green for the stock market strength color signal, and our portfolio is currently 100% in cash. We start the year off with $100,000 of trading capital and we build from there. We are currently at $100,190. The S&P 500 buy and hold investor, they gained so far for the year 2.55% year to date. So they're off to a good start, the buy and hold investor is. Here are some past returns for the model portfolio. Last week, the S&P 500 gained 1.03%. By the way, we use the ETF symbol SPY when we represent the S&P 500. We made one trade last week on the 23rd, and we did two cash secured puts and we brought in some income. Here are some of the trades, actually all of the trades in 2024. I got a little missing a little bit of the date there. I'll clean that up. Anyways, so here are our trades so far. If you want to see all my trades going back for the past 3 years, you can head over to Spy Trader Now at this website link here. There'll be links for everything in the description down below. Here is our equity curve for 2024 year to date for the model portfolio. Here is the equity curve for the S&P 500 buy and hold investor. And here are the two equity curves combined. You can see that over the past 1, 2, 3 weeks, the buy and hold investor has done just straight up. All right, here's the Fed Chair, Jerome Powell. And here is all the interest rate decisions made in 2023. Now, here is 2024, and guess what? The next announcement is next week, this week coming up, January 31. Are we going to have a 25 basis point rate hike? Are we going to skip? Are we going to drop rates? We'll see what happens on the end of this month. All right, now we're looking at things from a presidential election cycle theory, which states depending upon the year of the election, you have historical rates of return for the S&P 500 and down here for the NASDAQ 100. Currently, President Biden is in his 4th year historically on the S&P 500 that averages 6.7% annualized. Currently, the buy and hold investor is up almost 3%, just about half of the historical average in the 4th year of the presidential election cycle theory, and we're just in January, which is incredible. So that's really off to a really strong start here for the year. Now we're looking at things from the bond market outlook, and the bond market is saying stay out of the stock market because you still have an inverted yield curve and you have rising interest rates. All right, here's our friend Warren Buffett, the Oracle of Omaha. And here is CNN Business Fear and Greed Index. We are currently in extreme greed. Last week we were in greed, right about here. Now we are in extreme greed. So caution is advised. Now we're looking at a seasonality outlook. Currently in the month of January 2024, the month is up 2.55%. Historically, there's only a 45% probability going back 20 years that this is going to be a profitable month, and we're already up 2.55%. So seasonality basis is against us, but we're almost at the end of the month, so we're closing this month out positive. It would take a lot for us not to, and I don't think that's going to happen. Historically, the S&P 500 averages somewhere between 7 and 10% annualized. Currently, we're about 3% on the buy and hold investor. Now we're looking at things from a long-term outlook. This is a 20-year monthly chart for the S&P 500. We're in a bull run as long as we have a positive MACD, which we do. We stay above this line, which we are, and we stay above this line, which we are. So all things, we are in a long-term bull run. Now this is weekly chart, 5 years, S&P 500, and what does this chart tell us? We are still bullish. We are absolutely bullish here. You can see here in the thumbnail, 9 straight weeks up, 1 down week, and 3 weeks up. Just very, very strong, incredible advance. Now we're looking at things from a short-term outlook. This is a daily chart, candlesticks going back 6 months. I put in a Fibonacci retracement capturing the bottom up to our current top. It would be healthy to have a 38 to 61.8% return where there's no corrections coming back and then bouncing up, which would be healthy, but we're not getting that. We are making new highs here, and that's what we just recently did. We are advancing higher. Now, interestingly enough, I was trying to demonstrate how the MACD had reached historically very elevated levels. On the red vertical lines, normally when you reach these high elevated levels, you get a correction. This was a kind of a shallow correction. This was a very deep correction. And then here we are here with basically no correction, and we're advancing, making new highs. MACD has bottomed and is coming up, although it looks like it's kind of softening its trajectory, coming a little bit more parallel here. Now we're looking at a ratio chart, NASDAQ 100 against the S&P 500, and we've bounced at the top end of this trading channel, and the NASDAQ 100 is coming down, meaning that, and we also, the MACD has topped and is getting ready to cross below its signal line. This tells me that the NASDAQ 100 is going to underperform against the S&P 500 over the next 1 to 2 weeks. And generally speaking, when that happens, it's bad for the market overall, because for a healthy market, generally you want the tech-heavy NASDAQ to be leading the S&P 500. And in this case, it looks like that's not going to happen over the next 1 to 2 weeks. So overall, a little bit of a cautionary flag. Now we're looking at another ratio chart, equally weighted S&P 500 against the normally weighted S&P cap weighted 500. MACD topped, coming down, getting ready to cross its signal line. Slow stow, already below its signal line. Now, this is going back 20 years, weekly chart. Now we've seen every time that the ratio chart falls off of a cliff, like it did 2 times in the last 20 years, 2 other times. This is the 3rd time. The other 2 times, the normally weighted blue S&P 500 has dropped off of a cliff as well. Here, dropped off of a cliff here. But we haven't, this was a small, mild correction that we've experienced in 2023 after the ratio chart has fallen off of a cliff. And if that is it, that's signs of a real strong market. Just a very, very strong market. Now we're looking at the volatility, the VIX, the fear index. We are in the ultra low trading range. When you're in the ultra low trading range, that gives you opportunity for the S&P 500 to continue its advance. Now we're looking at the Thinkorswim platform 5-year weekly chart. And on standard deviation, and we have standard deviations, +2, -2 in gold, +1, -1 in pink, regression line dashed green. Currently, we're at 0.3 with upward sloping standard deviation lines, all bullish signals. You are halfway in between, just a little bit to the positive side of the regression line, giving you plenty of room to come up and still tag or just go above the +1 standard deviation, which would take you all the way between 525 and 550. So, and we're at 487. Now we're looking at a 1-year chart of the same S&P 500, but on this chart you're at 0.8 standard deviation, so you're almost at the +1. 68% of the time you're going to reach the +1 and then start to come down and correct down, which is what you did the last time here in 2023 July. So we want to be aware of that, meaning that the upside potential is starting to get more limited as you get to this +1. Now we're looking at the same chart, but we're going 6 months instead of 1 year. And you can see the standard deviations. Now on this chart, you're at the +1 standard deviation right now. So there's a 68% probability that you're going to go sideways to down. There's only a 30% probability that you're going to continue to go higher. And the higher that you go, the higher the probability is that it's going to flatten out and come down. So you're reaching a point over a shorter period of time where you're having limited, your risk to reward ratio is becoming less attractive. Now here I've got the stock market strength, and I've got asset classes and the 11 S&P 500 sectors here. Last week asset classes were at 75, this week we're at 75%. Last week the 11 sectors were at 77% strong. Now we're at 79% strong. They increased in strength 2%. So last week was a strong week across the board for the sectors. And as you know, we've got green in both, all asset classes combined, as well as the 11 sectors. Now we're looking at a 1-year chart of the 10-year Treasury yields, bond yields. Currently, we bounced, we hit a support line, bounced, came up. Now we appear to be moving sideways. Looks like this green line is a resistance line. And if that's the case, and if this is actual resistance and it starts to come down, and the MACD is already starting to soften, the histogram is already coming down here on the MACD. You can see all these things happening. If this is going to start coming down, that gives more credence that the S&P 500 is going to continue to advance during this time frame. Now, one interesting thing of note here, normally when the bond yields rise like they did from here to here, the S&P 500 falls like it did from here to here and here. But in this last time where the bond yields rose, the S&P 500 actually rose as well, which is unusual. So I just gave you a ton of information in this video. Now comes the critical thinking. What are you going to do with that information? Well, when I take and add this up, this is what I get. So as of January 27th, 2024, the market summation, according to me, your friendly host Ken with SPY Trader Now, the market just broke into new high ground, which indicated more upside is coming, but the market is still overextended. The pullbacks I have been looking for are so shallow that it suggests a very strong market. I don't want to put on leverage at this juncture. And you got the Fed meeting this week, which potentially is going to shake things up. But I will sell at the money cash secured puts for some income. So the current price of the S&P 500 at 487, we'll go ahead and do a couple of cash secured puts with a strike of 481. That gives us some income of $214. So annualized, that's not bad cake, where we're going to get an annualized 20% return on those funds. And hypothetically, if we do get exercised, we're still exercised with a discount of 1.53%. So that gives us and puts some skin in the game without taking extraordinary risk. So that's how I want to play. And this is just going out till Friday, next Friday. So it's only 4 trading days because I got to put the trade on Monday. So that is my expectation outside of a black swan event between now and Monday morning or Monday's trading day. If some type of a black swan event occurs, that's going to throw a wrench into this whole thing right here. But I'll let the market open on Monday, wait a couple hours after market open just to see if there's some swaying of the news or some event happening to trend the market. But if the market, after a few hours of open, stays kind of where it's at right now, 487, we'll go ahead and plant something like this trade right here. That's it. I hope you have found some value into this video. If you have not done so already, hit that subscribe button, ring that bell. Do me a solid and smash that like button down for me right now. I thank you and I wish you good trading.